Tech stocks versus momentum investing. Which one can grow your wealth the most over the long term? Today, we're going to be breaking down two great ETFs, as in QQQ and SPMO, and we're going to see which one belongs into your portfolio. So by the end of this video, I hope that you may have found some answers to your questions to see which one is the best. Maybe it's one, maybe it's both. So let's get to it. Hey guys, my name is Steve, and I run the Frugal Expat website, where we try to help people to save more and invest better. And today we are breaking down two of the most popular ETFs out there that can grow your wealth. You have QQQ, which is the Invesco Nasdaq 100 ETF, and you have SPMO, which is the Invesco S&P 500 Momentum ETF. These two ETFs can grow your wealth really dramatically, but they have two different approaches. One is tracking an index, one is doing a momentum index. So these are two different approaches to investing. Now we're going to break these down we're going to look at the strategy, we're going to look at the expense ratio, the risk, the diversification, the holdings, and the performance. And at the end of the video, I'm going to go over some of the goods and bads of each one of these and which one could be the best for your portfolio, and my opinion on which one I think is the best. Let's do a quick overview of these two ETFs. First of all, we have QQQ, which is the Invesco QQQ Trust. It tracks the Nasdaq 100, which makes up the top 100 non-financial companies on the Nasdaq exchange. Now, these companies include Apple, Microsoft, Nvidia, Tesla, Costco, Amazon. These are some of the top companies on the Nasdaq 100. And so this is a part of QQQ. Now, QQQ has been around since 1999, so it is an OG ETF. It's been around for a very long time, so it's seen the ups and downs of the market. Our next ETF is SPMO. Now, SPMO is the Invesco S&P 500 Momentum Factor ETF. This ETF tracks a momentum factor index that tracks the S&P 500. So these are some of the top 100 companies on the S&P 500 that are going crazy, as in like the momentum of these companies are going crazy with some volatility. And so it's looking at the top companies in that index. And so you got a little bit two different approaches. You got one that's on a little bit of tech and non-financials, and you got one that's, which one is doing the best in the last 12 months. Now let's break down the strategy of these two ETFs. First of all, we have QQQ. Now the QQQ strategy tracks the Nasdaq 100, which are the top 100 companies that are non-financials in the Nasdaq exchange. So these are weighted by market cap and market weighted. So what it's doing is taking some of the top companies that are innovating and creating, and they have the biggest market cap, and they're putting it in the index. I mean, we have companies that like Apple, Nvidia, Microsoft. We also have companies like Costco, which has done really well in the last 10 years. So these are some of the top companies in the Nasdaq 100. So it's purely simple. It's tracking an index. And so you're getting some of those top companies. Now with SPMO, it's got a different strategy. So it's got about a 72% turnover ratio, and it looks at the 6 to 12 months momentum factor of these companies. So every 6 to 12 months, they're going to change the way their companies are doing. So they look at companies in March and they look at companies in September. So we just hit September, and so some companies have rotated out and some companies have rotated in. About 40 to 41 different companies have rotated out and brought back in. So we have a lot of different companies that go in and out. So it's not really having the same sector every time. It's not having the same companies every time. Like the last 6 months, we had Costco. Now we do not. We have Oracle instead of Costco. So that's a little bit different with SPMO. You have different strategies. One is focused on the index of the Nasdaq 100. One is focused on momentum. Let's get on to expense ratio. Now, expense ratio is the cost of managing the fund. And so with these, you have different expense ratios. My personal opinion is when you have cheaper expense ratios, it just means it's better because your money is working more for the long term. With QQQ, you have an expense ratio of 0.20%, which means it costs about $20 for every $10,000 invested. With SPMO, you have an expense ratio of 0.13%, which means it costs about $13 for every $10,000 invested. QQQ is more expensive. If you wanted a cheaper version of QQQ, you could always get QQQM, which is 0.15%. But today we're talking about QQQ. So SPMO wins in this factor with having a cheaper expense ratio means in the long term, your money is working more for you in the long term and it's going to cost less. Our next category is risk. Now with QQQ, the risk profile is going to be a little bit different than SPMO, and with QQQ, you have a lot of risk with having a huge concentration in technology. So right now, the QQQ holdings has anywhere between 50 to about 55% of its holdings in technology. It's surged up to 60% before, but it's in that range. And in the top 10, we're talking about a huge concentration in some of the top names like Nvidia, Apple, and Microsoft. And so this could be a little bit of risky. You have tech risk, you have concentration risk, and if there is a crash, it could hit hard. QQQ crashed hard during the dot-com boom, and it took 10 to maybe 15 years later for it to kind of rebound. And it also crashed hard in 2022. The Nasdaq 100 was down almost 33%. But with this risk, you also have some of the rewards having some of these tech companies. In 2023, the Nasdaq 100 was up about 54%. So it may have dropped hugely during 2022, but it also rebounded. So that's part of the risk and reward you have with owning an ETF that tracks the Nasdaq 100. Now, SPMO also has its own risk because it follows a momentum factor. So what happens is if it doesn't have much momentum or it's having some of the biggest companies and those companies crash, well, you could have a huge crash. And there's also the risk as in it has a 72% turnover ratio. So that means some of the winners may not be the winners of tomorrow. And so you may not know what's going to happen. And you're just like, all right, let's just roll with it. This is my FOMO, you know? That's a little bit of risk with SPMO. Now, the real winner of this category is, there really isn't a real winner because QQQ and SPMO really have both high risk. But QQQ is a little bit more predictable than SPMO. SPMO just follows what is hot, and sometimes that hot thing could be not. So that's the two risk profiles of both of these. Let's get on to our next category. All right, let's talk about diversification. So QQQ has about 50 to 55% in technology. It's also got about 55 to 60% in its top 10 holdings. So right there, you do have about 100 different holdings in QQQ, but the diversification as you get to those top 10 are more concentrated. So you're gonna have a little bit less diversification with QQQ holding about 60% in the top 10 with about 50 to 55% in technology. So it's got different sectors. It doesn't have any financials, so no financials right there. And it's got just the ability to not be as diverse as other big time growth ETFs like VGT or even a SEHG. Now with SPMO, you have all different sectors out there. Now, that doesn't mean it's as diverse, but with 100 different companies from the S&P 500, you have some of the top hot companies on there, and that could be a JP Morgan. That could be financials. That could be tech. That could be maybe consumer staples or even healthcare, depending on which sector is hot right now or which companies are hot right now. So that means it could be very diverse. On the other hand, if only one sector is really hot, it could be also very less diverse because it's more concentrated in that sector. Now, if we have a winner, right now, I would say SPMO is the winner because it has financials. It's got other sectors that could be doing well with different companies that are doing crazily. Now, with QQQ, you have no financials, so that makes it a little bit less diverse, and you have a huge concentration in some of those top companies. So that's gotta be something to look at. Let's take a look at the holdings of each different ETF. QQQ, some of the top holdings you have Apple, Microsoft, Amazon, Tesla, Nvidia, Broadcom, you have Costco. These are some of the top 10. Now, typically you have some of these already in the ETF, and as they grow and grow, you're going to continue to have these same companies be in the top. And so that's something to think about. You know what the companies are. You know what the top 10 holdings are. With SPMO, the holdings, they rotate every 6 to 12 months. I was talking with one of my commenters, Gary, about this, and he was like, Steve, you're right. They do rotate 72% of their portfolio in and out. And that is something that could be on some people's mind. Right now, you have Broadcom, you have Oracle, you have JP Morgan, you have Walmart, and Nvidia as a part of this ETF. Now, that could change in the next 6 months. The last 6 months you had Costco, but Costco has been rotated out and they brought in Oracle to exchange that. So you have different companies that are coming in and out. Now you have different sectors as part of this, But right now, I would say if you're looking for something with more predictable holdings, QQQ are more predictable. You know what the holdings will be, not just 6 months from now, you'll know them for the next year, maybe the next 5 years, and depending on how that market cap is weighted on the NASDAQ 100 index. So that's something to think about. Now, when we take a look at performance, and performance is something that a lot of people want to take a look at because we want our money to grow. We want to grow our wealth. And so we're going to take a look at these kind of factors. First of all, let's look at QQQ. QQQ has been around since 1999, so it's like an OG. It's had ups and downs with the market, and we have seen that with a crash in the dot-com boom. We have seen it with the crash in 2008. We have seen it with a COVID crash, a little bit of a huge bear market in 2022, and it has survived and it has grown people's wealth over the long term. Now, the average over the last 20 years has been roughly around anywhere between 13 to 15%, depending on when you watch this video. And it's been doing pretty well in the last 10 years. In the last 10 years, it's have an average of about 19.77%, which is a great number. In the last 5 years, it's been 18.29%. So when we're looking at this ETF, it's done really well in the last 10 years. It's done pretty good in the last 5 years, but we've also had a down market in 2022. So that kind of averages on the 5 years. So it does really well. So it's a great one if you're looking to grow your wealth. Now let's look at SPMO. Now, SPMO's performance is more cyclical, as in when momentum is doing really well, it's gonna go crazy. It's gonna go crazy with those bull markets. When momentum is not, well, it's gonna struggle. When it's a flat market, it's going to struggle because it's hard to find some of those great companies that are on fire. And so that can change the way this performance rallies and can change the way this performance goes in the long term. So we take a look at the performance over the last 10 years. In the 10 years, it has averaged about 18.54%. And in the last 5 years, it is averaged about 21.79%. So right there, you have QQQ beating SPMO in the last 10 years average, and you have SPMO beating QQQ in the last 5 years average. Now, I took a look at some of the returns over those years, and I have seen that QQQ from about 2017 to about 2023, it was beating SPMO, except for 2022. 2022, it was down 33%, while SPMO was actually down only 17%, beating the S&P 500 and beating the NASDAQ 100. But when we look at 2024 and 2025, SPMO has done much better than QQQ. But that's also just a little bit short term. We have seen that SPMO has been usually on track with QQQ, and then sometimes QQQ does much better, as in QQQ did really well in 2023, but didn't do so well in 2022. So those are some things to look at. Now, my personal opinion and looking at kind of the numbers, 10-year average, QQQ is doing way much better. 5-year average, well, of course, we can see the numbers. SPMO has done better than QQQ. So those are some things to look at. If I had to pick a winner, I would say QQQ wins just because of the long-term average it has been winning. Before we dive into the pros and cons of these two ETFs, I want to make sure to let you guys know that one of the greatest places to track performances of portfolios is Snowball Analytics. I use Snowball Analytics all the time, so I got different portfolios on there and I can track my net worth. I can set up goals. I can see how my dividends are doing. I can see what my percentage is compared to the S&P 500. And the greatest part is I have it all in one place, either on my computer or even on a phone app. And I can see how the market is doing every single day. I can see how the market is doing in the months, and it's a great place to track my performance. Snowball Analytics. I'll leave a link in the description and in my pinned comments so you guys can take a look. You guys can sign up. You can pay for it if you want. There is an affiliate link for this, and if you do pay for it, I would get a small commission, but it's at no cost to you. And if you want, you can also go with the free version. It doesn't matter to me. It's just a great place that I like to track my portfolio, and you can do the same as well. Link in the description and link in the pinned comments. Let's get on to the rest of the video. Now, there is goods and bads to both of these ETFs. First of all, let's look at QQQ. They're goods. It's got pretty good performance. It's got a good diversification. It's got some pretty good risk, and it's not as expensive as some other ETFs out there. So with this ETF, you also have some bads. There may be too much concentration in tech. Maybe it will be down in down markets, and the expense ratio could be a bit cheaper. With SPMO, the expense ratio is much cheaper. You have a momentum factor, which could be good in some years and maybe not so good in others. This has got a better diversification, as you can have different sectors besides just technology. You can have healthcare and financials that could dominate in this ETF. But, you know, it does have a high turnover ratio, and you may not have the same stocks you wanted 6 months ago because it has not been as good the last 12 months, and so it has turned over those. So there's some goods and bads. In my personal opinion, if I looked at both of these ETFs, most people probably should look at QQQ. The reason I say this is because I think QQQ is very straightforward. You know what you're getting, and it's got a solid performance over the last 10 years. It's got solid performance over the last 20, and it's been around since forever, like 1999, which is not forever, but it's been around for a very long time. This ETF is also very liquid, so if people like to trade options on it, it's able to do that. This ETF also has a pretty good track record for the long term, and it's a simple approach. Now, SPMO is a great one as well. It's very interesting. It's got momentum factor, so it changes a lot, and in some markets, it can do really well. Like it's done really well in 2024 and in 2025, but sometimes it may not do as well as the others. So this is just an interesting ETF that you could add to your portfolio. So let me know in the comments. Do you like QQQ? Do you like SPMO? One of these could be in your portfolio right now, but if you really want to check out why I think QQQ is one of the best, you can check out that video right up here. All right, now I'll check you guys out in my next video. You guys take care and see you later.